Want to invest in great companies, but not sure where to start or what to actually look for? In this video, I'm going to cover 5 steps to picking better stocks. There's none of this YOLOing into companies without knowing what you're actually buying around these parts, okay? I know what you're thinking. Nikki, you shouldn't pick stocks. Nikki, just invest in an S&P 500 index fund and that's it. Nikki, you'll never beat the market. Okay. Hold the pitchforks just for a moment, please. To start, I do hold my index funds, and I love my index funds. But guess what? Sometimes index funds do not get you the exposure that you may actually want in a certain company or type of industry. This is where active investing actually comes into play, and I do actively invest part of my overall portfolio in addition to holding my trusty funds. So let's say you want to invest in great companies to add more exposure than what you may get with your fund. How do you actually do it? Well, once you have a company that you're actually interested in, it's time to dive into some financial details. The first step is to find out if the company revenues are actually growing and at what percentage. There are plenty of places where you can find this information out. Check out my video on my top investing research tools that I'll link up in the description. You want to use a resource that can show you a comparison quarter over quarter or year over year of revenue growth. Year over year just means that it's comparing the current year to a prior year, and so on and so on. Or maybe it'll show you that there's no growth in the company revenues. The latest earnings reports on the investor relations websites also come in handy for finding this information out. They usually tell you how earnings grew over the same quarter in the prior year if you want to get a quick idea for the base of your research. So, what is low versus high growth in revenue? Well, let's dive into some data, shall we? Now, before I dive into this, keep in mind that revenue growth for 2020 through 2021 is going to be a bit abnormal due to the recent global crisis, but it gets the point right across. Okay, here's the average revenue growth year over year for companies in the S&P 500 index. You'll see that revenue growth runs anywhere from 6 to 10% going back to 2016. Something to note is that the S&P 500 index holds some growth companies that are growing revenues at higher rates, but also holds a lot of value companies which tend to grow revenues at lower rates on average. Now, let's get some perspective and look at the revenue growth rates for companies in the NASDAQ 100 index, which tends to be more tech-heavy and higher growth focused. So, revenue growth for companies in this index tends to be much higher, ranging anywhere from 17% to 36%. It's a pretty big difference when you compare the two. The higher the growth, the more attractive a company may appeal to you. But buyer beware, these companies may also be trading at higher valuations because of that growth. This is where the next few steps come in handy to move us forward in the investing decision process. The second step is to dive into how profitable the company is or isn't. And profitability is different from revenue growth. Are they burning lots of cash? Burning cash is a fancy way of saying they're literally having to eat into their cash that they have on hand to run the company. And if this continues to happen, they will eventually run out of money. That's not great because that usually leads to a company having to take on debt to get more cash on hand, or they end up raising money through issuing more shares of the company's stock. Issuing more shares of stock messes with your stock ownership. You own less of a company if they keep issuing shares, since ownership of that company is distributed throughout their share count. Think of a pizza. If it's cut into 8 slices, you own 1 slice, which is 1/8 of the pie. But if they cut the full pizza into even more slices, which represents a company issuing more shares, your 1 slice that you own gets smaller. This is called dilution. Think of dilution like you dilute a glass of whiskey with water. Here are some examples of companies who have issued more and more shares over the years. Tesla has been doing this, but the stock price has continued to perform despite this, mainly due to investors' hopes for the future of the company. Tesla is a capital-intensive business, and they need a lot of money to operate. This is why they've taken advantage of raising capital for the business while the stock price flies higher by issuing shares. Here's another example of a company increasing their share count. Now, here are some really high-quality companies doing the exact opposite. They are reducing their share count, which gives shareholders more ownership in the business. Yes. This is good, and when companies have a lot of cash on hand and a healthy business, they do this to return value to their shareholders. So this is like anti-dilution. You're pouring more whiskey into the glass. Here's AutoZone. Look at that beautiful downward trend, giving shareholders a bigger piece of the pie. You gotta love that. Here's another company reducing share count. Good old Walmart. This is why it's important to understand where a company stands financially, and if they're using their revenue to reinvest and fuel more growth, or are they having to use debt and share issuance to survive? And where will that get them in the end? Do you think that they'll still find success despite these moves because of the future opportunity being so large? Or is management being reckless and the revenue growth you're seeing isn't justifying the moves that management's actually making? These are all questions that you have to find answers to. The third step is to look to see if they have any debt. If the company has debt, is the debt manageable in comparison to the assets that they own and their net income? Let's get one thing straight. Debt is not a bad thing. Many companies have debt, and it's perfectly fine and manageable. But debt on top of a business that is burning cash and not seeing revenue growth is not good. We call that a melting ice cube. Keep that in mind. A quick tip is to make sure that the business can actually cover the interest expense with no issue. The fourth step is to look at the company's market capitalization. Market capitalization is the company's share price multiplied by the shares outstanding. And remember, these are the shares available for people to purchase to get ownership in the company. Market cap is how we compare the size of one company to another. Ideally, we want to see companies' market caps grow over time. Like you can see in this photo, the purple line is Apple, which has grown exponentially to a $2 trillion, yes, I said trillion, dollar market cap. I mean, what is there to say? Apple just continues to slay doing business. They're a cash cow. Their consumers love their products. They're just really a great company all around. But it's not always tulips and lollipops in market cap world. Sometimes companies' market caps stay stagnant or decline as they lose market share to competitors. Or maybe they're just operating in dying industries. The orange line is Intel, a company who manufactures and supplies essential computer technologies, which has been actually losing market share to companies like AMD and Nvidia. Their market cap has stayed sort of stagnant over time since the 2000 tech bubble. This is actually a company that has been able to diversify their business and still grow revenues over the past few years, currently growing revenue at around 8% year over year, but the market hasn't appreciated the company losing its competitive advantage in their technology. Then we have the blue line, which is Macy's, which is a department store. Their market cap has actually been declining as e-commerce has taken the world by storm, and traditional department stores in the mall have become out of favor. Macy's is essentially in desperate need of a turnaround. Speaking of turnarounds, it's totally possible for a company to do so. So it's important to really know the company's story if you're going for a turnaround stock, especially if market sentiment is very, very negative. It's important to look at the market cap and business in comparison to others to help you make better investing decisions and pick companies that have the opportunity for growth ahead of them. We've made it to the fifth step, and that is to find some comparable companies and doing even deeper analysis. This is where everything sort of comes together. When you go to buy or sell a house, your realtor is going to compare the price of your house to other houses in the area. But you're comparing way more than one thing. You're comparing the size of the yard, how many bedrooms or bathrooms the house has, square footage, and even the condition of the home. Companies are very similar. You'll want to compare metrics like revenue growth, price to earnings, and/or price to sales ratios, just to name a few. Valuation metrics like price to earnings or price to sales help us get a grasp on how the market is pricing the company, but they are kind of useless metrics on their own, really. It's all about the comps, just like the house example. Before I lose you, I'll break a few valuation metrics down. The first is a price to earnings ratio. This basically takes the price of the stock divided by the earnings per share that the company generates and gives us a number that we can compare to other companies' price to earnings ratios. Remember those shares outstanding that we were talking about earlier and how companies can issue more shares or buy back shares to increase or decrease that overall pie? Think of each share getting assigned a part of the company's earnings. That is earnings per share. Let's look at a few companies in the retail sector to actually compare. Granted, some of these companies are still experiencing lower earnings after what 2020 brought us, so the price to earnings ratios may be deceivingly high, but you'll notice that Lululemon has the highest price to earnings ratio. This has been the case for many years when you compare it to other retailers, because their revenue was growing at higher rates than others. Now we move on to the price to sales ratio, and the price to sales ratio is generally the same idea as the price to earnings ratio, except you're dividing the market cap of the company by the actual sales generated or expected to be generated for that year. Price to sales is a more useful ratio for companies that are not quite profitable yet and don't have positive earnings. This doesn't mean a company is bad. It could just mean that they're in growth mode and they're reinvesting in the business. I personally tend to look at both price to earnings ratios and price to sales ratios when doing comparisons. Whew, that was a lot that we covered today in today's video, but valuations actually do matter, and doing the right legwork outlined here today will help you make much better investing decisions. To recap, the 5 steps to picking better stocks are: 1. Get familiar with the company's revenue growth. Is it low, high, or maybe even negative? 2. Find out how profitable the company actually is. If they're not profitable yet, are they still trying to reinvest in the business? Do they look on track? 3. Look at how much debt the company has. Is it a manageable debt load? 4. Figure out the market capitalization of the company. This is an important metric to learn and decide if there's room for it to grow in comparison to other companies that are similar. 5. Use other valuation metrics and compare them to similar companies. Get a little more details going and get a more rounded thesis. All right, finance fam, I hope you found this useful. Please smash the like button for me if you did. Now go take your new knowledge and go poke around on an investor relations website of a company that you love. I'll see you in the next video.